Happy Windy Friday. Welcome to the latest live edition of the Jack and Bill Show, April the 8th, 2022. We've had, it's been a most interesting market, as we talked about last week for the first quarter. This week, we rebounded last week. This week, we were down 3 of the last 4 days. I was reading yesterday, this morning's Wall Street Journal. It's the first thing I do to start off every morning. And the S&P 500 down 5.2% on a total return basis through yesterday. And I think we closed down about 40 basis points. It'll go across here in a second. So that puts us, call it, we fell about a quarter of a percent, 0.27% today on the S&P. So Bill, we're down, call it 5.5% year to date. And I think the Dow was the only major index that went up today, with the NASDAQ and the Russell down more, down over 1%. Safe havens, some safe havens doing well. I see Ethereum was up, Bitcoin was down 2%, silver up to 2486, the yellow metal gold 1947 up 0.5% today, call it $10. West Texas Intermediate at $98, up about 2% or about $2. And but this is what I find to be most interesting, Bill, because I think we're going to discuss some of this during this episode. Weathering the potential coming storm, or we'll address that too. Is there a storm? What should we be doing with our money? I'll give you a little tidbit that I was looking at. So the S&P 500 through yesterday's down 5.2%. What about the bond market? So if you first saw this war thing and wanted to get out of equities or go to safe havens, actually before the war started, we had this huge rotation out of growth for fears of this coming Fed tightening cycle. And stocks really haven't gone down. The war didn't really do anything, only for a few days, really. And we're something like day 40, day 45, somewhere in there into the war. So if you said, well, okay, I'm going to put my money in short-term bonds or short-term, here are 2 of the largest 100 exchange-traded funds, 2 Vanguard funds, Vanguard Corporate Bond Fund, VCSH, and BSV, Vanguard Short-Term Bond. BSV is down 4.1% year to date, and VCSH is down 4.5%. Now, the Fed has only tightened 25 basis points or 0.25%. So, those things have a duration of, I would say, around 1 or less, meaning if interest rates go up 1%, they would only decline by 1%. But they've declined by, these are not credit spreads widening or anything like that. It's just, the market got ahead of the Federal Reserve with the announcement and tightened before the Fed, had to tighten. So,
it seems like the bond market is anticipating more aggressive tightening, and it has responded. The equity market, though, really has not responded, not like the bond market has.
I would say this week we had the NASDAQ market, which we would say, when you talk about risk in the bond market, you use in stocks, most people use standard deviation. In the bond market, most people use duration. So, which is the time weighted average of the cash flows. So if, we've said this before, if you have a 30-year treasury bond, it has a duration of about 20. meaning if interest rates go up 1%, it's going to decline in price 20%. Yeah, I mean, look at Dodge and Cox Income Fund, a very popular, very strong performer for decades. It's down 6.3% this year, Bill. And even their balanced fund, which is like 60% stocks and 40% bonds, I mean, it's been hammered too. So these are what we would call traditional, safe havens. And I look at the yield curve today. The 2 years at 259. I think in December it was at 0.75. The 10 years at 271, and the 30-year today, I saw it at 278, and it may have gone up in yield every day this week. So also looked at today's Wall Street Journal. This is kind of interesting if I could put my hands on it really quickly, but this is something that could be useful in this discussion, is that mortgage rates were trading about 0.25% over the 10-year, and very quickly in the last few months they've gone to 1.25% over the 10-year. So we've had mortgage rates go up much faster than the 10-year Treasury, and I don't know where that is in here. But anyway, well, William, what are we going to discuss today? What do you have in your notes over here?
I'm still thinking about your comment about the first thing you do every morning.
Reading the Wall Street
Yeah,
Journal?
that's the first thing you do every morning.
What's wrong with that?
Nothing. I was just thinking about that.
Oh, okay.
Okay.
Well, no. Let me go back. The first thing I do, the dogs hear me. We have two large male old dogs. Buddy can't hear me, but he sees John, Buddy and John. And so they hear me stirring, and John starts barking and tries to wake up the whole neighborhood. He's loud enough to do it. So I'll walk into the pantry, the first thing I do is throw them outside so they can urinate. Then they're jumping at the door, still barking, waking up Stacy. I run into the pantry and give them a dog bone, a dog biscuit. They wolf that down. John runs back and jumps in bed with Stacy, and Buddy hangs out with me until I give him his scrambled egg. So, but that's after I sit down and read the Wall Street Journal and fire up the coffee pot.
Okay. Apologies to all the viewers for me getting us off track.
Way to go.
What was that, Wesley?
Way to go.
Thank you. So, we were talking about, for today's topic, weatherproofing a portfolio. Well, if we're going to weatherproof a portfolio, then that implies that we are expecting bad weather. Okay, so just like as seasons change, you weatherproof your home. Or if you're expecting a storm system, well, you're going to park your vehicle in the garage or under a cover. There are just things like that you do. Or you bring the patio furniture in so it doesn't get blown away, or you can go on and on. Well, there are signs that we can look to that are indicative of coming volatility. We've already witnessed volatility in the marketplace, and we can reasonably expect that we will have more volatility in the markets. And it's not something that you necessarily need to be fearful about. That's just part of investing. We go through these economic cycles. That affects corporate earnings. We do have unforeseen events like wars, natural disasters, things like that. We also get in situations where we can see asset classes being overvalued. We can look at situations where central banks are moving in a fashion that is not conducive to higher asset prices. So there's a lot of things, that could potentially cause us to want to weatherproof the portfolio. We've talked on this show many times about valuations in both stocks and bonds being high. And when that's the case, yes, you can continue to still invest in stocks and bonds. You just need to be aware that the opportunities going forward will be less. So the price you pay for something today will affect the return you're expecting going forward. So if you're paying a very high price today for an investment, then just expect that the returns going forward will be lower. So yes, in today's marketplace, stocks and bonds are both, broadly speaking, expensive. So that is one condition. Another condition is that the U.S. Central Bank is tightening policy. They're doing it in a big way in response to high inflation. So that will have a negative impact on stocks and bonds. We are seeing geopolitical risks manifesting, and that's affecting the global economy. What's going on in Ukraine is affecting the supply chains, and it is causing inflation and things like commodities. So there's a lot of things that we can look to, and we do believe that this is a time to be weatherproofing portfolios. We've been doing this for our clients. This is not something that we just woke up this week thinking about. We've already been doing a lot of this.
Yeah, and I'd like to interject
Yeah.
and say that, this is our model portfolio. Bill, you developed this spreadsheet. And if you own our model portfolio, where the S&P 500 declined 4.6% in the first quarter of this year, and the NASDAQ market declined more, our portfolios actually made money. So if you had a balanced portfolio, because we did feel like we foresaw coming inflation, we wanted to own things that would take advantage of that, and that continues to be the case. So keep going.
There's some general rules of thumb that are very good in application in seasons of high market volatility. I would say one is know what you own and why. If there are things in the portfolio that you are unfamiliar with, you don't even know why you own them, well, those would likely be good candidates to eliminate from the portfolio. So when we say know what you own, it's not just about knowing what kind of investment is or who the issuer is. It's also about understanding the risks of that investment, of that issuer. So identifying risks is another strong rule of thumb in this kind of market climate. You need to know what you're most susceptible to. And it's no different than, say, you getting property and casualty insurance. Well, you have to identify the risks, and then you purchase insurance to cover those specified risks. So there are market risks, risks that can affect the entire market. With a bond, you have credit risk, the credit risk of the issuer. There's interest rate risk, and that's the risk of interest rates moving higher, and as a result, bond prices going lower. There's political risks, like, for example, let's say you bought a Russia ETF fund last year. Well, guess what? You have suffered greatly from political risk. And I'd say another rule of thumb, that's very applicable is don't make big portfolio changes. Don't overtrade. We're going to have up days and down days. Something that's very common in a bear market, and I'm not saying we're in a bear market, but if we were to go into a bear market, is you have wide swings in prices from day to day. And so you've got to be careful not to overtrade the account.
Yeah, we're a bear market being defined as down 20% or more. The NASDAQ market actually did hit down 20, not down that much now. But, again, S&P 500 only down 5. But Bill, I thought I would share. I saw this chart. I Googled this and looked this up. That the source is actually Charles Schwab and the National Bureau of Economic Research. But since the end of World War II, we've had 13 tightening cycles, and 10 of those tightening cycles produced a recession.
Mm-hmm.
So the Fed used monetary policy to raise the Fed funds rate to try to slow down an overheated economy. And in 10 of the last 13 tightening cycles, they overdid it and a recession followed. And I think for Cut It With a Meat Axe, one of the easiest ways to define what a recession is two consecutively declining quarters of GDP, gross domestic product, declines in the U.S. So GDP is still roaring in this country, in the U.S., but we've got the average bill is, and this is encouraging news right here, months till the recession starts from the first rate hike. On average, it's 25. So the quickest one of all 13 of these, of course, 3 of them are not applicable, but 2 times in 1973 and late 1980, it took 10 months before recession started. So this go round, we started tightening in March at the last FOMC meeting. If you add 10 months to March, that puts us to January of next year. So there are some other things. I mean, you could say geopolitical risk. It could be fiscal policy risk coming out of Washington because they want to do tax hikes. And I would say this is not the right time to be raising taxes, on Americans. But here's why the Fed has been forced into this. If you go back 15 months ago, we were running inflation under 2%. And that is one of the dual mandates of the Federal Reserve: maximum employment and 2% inflation. Okay. So the CPI print that just came in last month, this comes out once a month, was 7.9%. That's the highest reading in something like 40 years. And the PPI, Producer Price Index, call it wholesale prices, came in at 10.0. These numbers come out next week, and they're forecasted to go up even more. So just, defining, the Consumer Price Index is forecasted to print at 8.4%. That's an 8.4 increases in a basket of consumer price goods year over year. And then the PPI is forecasted to be 10.5. These numbers are absolutely out of control, enormous, and seemingly climbing every month, which now has the Federal Reserve very quickly making policy changes and talk about going, just in the last 30 days, from quarter point increases every 6 weeks this year. That's how frequently the Federal Open Market Committee meets, to perhaps half a point increases. And so the next meeting that they have is May 3rd and 4th. And I'm anticipating, a half a point increase. But the bond market is discounting this right now. Yeah. And that, yeah.
So let's just sum up what we know. Okay. We know that the Fed is tightening, right? They're in a tightening mode. And we know that the Fed's original primary mandate is reining in inflation. That is the primary mandate. Full employment was something that was added on years later. And actually, those two mandates kind of conflict. All right, so the Fed's tightening. And we also know that majority of time when the Fed's in a tightening phase, as you shared with us, that it leads to recession.
77% of the time.
And we also know that when the Fed is moving, whether it's stimulating or forcibly contracting the economy to rein in inflation, we know that the Fed takes things too far. They will go too far in either direction. That's been the pattern. So knowing that, and also, Jack, you said correctly that on average, we go into recession 24 to 25 months after the Fed starts tightening. Well, guess what happens before that? We see asset prices move. So you'll see stock market start to react to a recession before we officially say we're in recession. So knowing all that, that's why we can say that we need to be thinking about weatherproofing the portfolio.
And they're forecasting right now for the tightening cycle to end at the end of 2023. In other words, the Fed is forecasting that they're going to have this inflation problem under control by the end of next year. I personally would beg to differ, or I would say I question that. So, you know, I believe, I'll use a cliche, that the trend is your friend until it ends. And we own some things. You know, I wouldn't be getting out of energy related things right now. You know, I mean, it's okay to, if you have a 5 or a 10% weighting in energy, you know, you can trim that and maintain that weighting if you still like it.
Well, all right. So you just specifically mentioned an investment that would work well in this climate.
Yeah.
Why don't we go through, you know, the different asset classes?
That's good.
And we can, you know, give some suggestions, recommendations on how you could weatherproof your portfolio within these asset classes.
Yeah, I think that well, one of the first things that you would want to consider are defensives, and that's not to be confused with defense contractors. But since we're in a war, defense contractors might be defensive, or I guess you could call them offensive. But defense contractors might be a good place in a portfolio right now as well. But by defensive names, we're talking about companies that always make money regardless of where the business cycle is. And those would be in direct contrast to cyclical stocks that make money when the business cycle is growing, and they don't make money when the business cycle contracts or we find ourselves in recession.
All right, so a good example of something that can make money regardless of the underlying economy would be things like consumer staples. People will always buy toilet paper.
Or cigarettes. People smoke more when
they're
there's
stressed.
trouble. So beer and whiskey, wine.
Toothpaste.
Toothpaste, healthcare, big pharma.
Mm-hmm.
You know, so healthcare stuff, because people are going to go to the doctor regardless of where we are in the business cycle.
Yeah.
So those are things, you know, certain healthcare names. There's certain, I don't really like hospitals right now because I think the hospitals have emptied out because COVID has looks like we're starting to win the battle with COVID, and we've also got a problem with hospital earnings and staffing with the cost of nursing escalating dramatically. But those are some of the defensive grocery stores, foods, utilities. Utilities can tend to be interest rate sensitive as well, so they can do poorly with
That's a
rising
good point.
interest rates. But Bill, I looked at that today, and one of the
Utilities have been doing well year to date.
year to date, they are year to date. Utilities Select Sector XLU, that's an ETF that's up 7.2% year to date, and I'm sure it has an above market dividend yield.
Yep.
Yeah, so they have.
Here's another one.
But that also has to do with the shortage of power and the power grid, this ever increasing move to green and electric, the mandate for automobiles, to be high mileage, and the move to electric. That's a good play if you buy into that.
Mhm.
That the power grid, we need some more CapEx spending and growth there.
Right. I'd say in general quality. So within your stock allocation,
Yeah.
focus on names that, for example, generate strong cash flow. All right. So companies that bring in a lot of revenues, low leverage. So this would be the opposite of junky stocks. So a company that has little debt on the balance sheet is going to be stronger. They're not going to be burdened with higher interest payments. And yeah, we did talk about low sensitivity to economic decline. Here's another one, low PE.
Yeah,
Right.
here you go. Look at the Vanguard Mid Cap Value ETF, VOE, is down 1.2% this year. Excuse me. Vanguard Growth, which is high PE, VUG, is down 12%.
See, so when the stock market takes a turn lower, you would expect the most expensive names, the highest PE names, to get hurt the worst.
Vanguard Value is actually up 1.0%. That's Victor Tango Victor. So that's right. And you mentioned that. We own several ETFs in a series where we own international, global, small cap, and large cap,
Domestic.
where they trade at the highest multiples of free cash flow to enterprise value. So they're large, diversified portfolios that sell very inexpensively, and these are performing companies. So those have made money so far this year.
Yeah, I mean, there are pricey stocks that have zero earnings, and people buy them up all day long.
Yeah.
They're not generating free cash flow, and those are junky stocks that you want to avoid in this market climate.
So we have, and this is the inflation play. We own pipeline companies. We own an energy ETF, which is still trading at a double-digit discount to what the underlying assets are worth, and it yields between 4% and 5%.
And those are some obvious plays in an inflationary environment. But what about this?
Financials.
What about just pricing power? Okay, we call those companies price makers. So think about companies that can dictate the price. They make the price. They're not price takers. So price makers can raise their prices as inflation goes up. That would be a good inflation hedge.
Yeah, the other thing is we actually have positions in 3 different algorithm run 40 Act funds or mutual funds that have rules-based algorithms that tie into the commodities markets.
Okay, so now you're talking about alternatives. Okay, so
Yeah.
that's just another asset class. And so this asset class, which is not widely understood, and it's kind of an umbrella term that captures basically anything that doesn't fit neatly into the stock or bond category. But that's a good place to be positioned in this kind of high volatility environment. So basically, we're looking for things that are non-correlated to stocks and bonds, so they can perform regardless of what's happening in the stock and bond market. It used to be for a long time that if we were experiencing stock market volatility, you could depend on bonds because they were negatively correlated, meaning if one goes up, the other goes down. But in this environment with low interest rates going higher, we're seeing positive correlation between stocks and bonds. So
Yeah,
that's why we see both selling off.
I mean, we've gone the whole gamut there. They've been at times perfectly negatively correlated, and now perfectly positively correlated.
So you need to have other things in the mix whose performance is not tied to stocks and bonds. We could also throw in the category of alternatives, hedges. There are legitimate reasons to put hedges on. Think of it like insurance. So if you don't want to outright sell positions, well, you could add things that would hedge against downside price movements on those assets. So you just have to know what you own and understand what would be an effective hedge, that could help you should we see price declines. All right, so that's alternatives. All right, bonds. Let's wrap it up by talking about changes to be made within the bond bucket. One of the biggest things, that we would recommend people do to weatherproof their bond allocation is protect against interest rate risk, and that involves shortening duration. So getting out of long dated bonds and buying into more shorter dated bonds, and understanding the duration of your overall bond book.
You can even own negative duration bonds as well.
Yeah,
So bonds-
explain how that
Well,
would work.
that means that if interest rates go up, ordinarily, if you have a bond with a duration of 10, interest rates go up 1%, it's going to decline in price by 10%. So if you have a bond with a negative duration of 2, if interest rates go up 1%, it's going to appreciate 2%.
An example would be an adjustable rate.
Exactly. Yeah. So,
And here's something that we've been doing recently is moving out of very short duration bond funds and into short maturity individual bonds. So there's pros and cons of owning bond funds. But if you have bond funds and you say, hey Jack, hey Bill, I'm not worried about interest rate risk because this is a very short duration bond fund. Okay, that's fine. And there are some things working for you because as monies come into the fund, whether it's interest payments or it's just money flows coming in or bonds rolling off as they mature, then the manager gets to put that money to work at now higher interest rates, and that can help over time.
yeah, but I'd like to point out again, as I did earlier, if you look at Vanguard Short-Term Bond Fund, BSV, down 4.1%, and I'm sure it declined more today. Year to date, down 4.1%. VCSH Vanguard Short-Term Corporate Bond ETF down 4.5%. If I had told you 6 months ago that was going to happen, or if I had told you that in December, you wouldn't have believed it.
It'd be hard to believe.
So this is not as easy as it seems.
No, and it takes time for those new money flows to get reinvested at higher interest rates. So that will work over a longer time.
Yeah, I might add that's a safe haven that's failed us year to date.
Yeah, over a short period.
Now we don't have a lot of exposure there, but I do like those things in the current climate because I think the market is already discounting a lot of tightenings. So with each tightening, It doesn't mean that these yields are going to go higher.
But if you do own these bond funds, it could be open-end mutual funds or ETFs. Take a look at the yields, the distribution yields on these funds, and then compare that to what's available in individual bonds. So we've been getting out of some of these short duration bond funds because we've been finding individual bonds with much higher yields. And so we know what we own. We've got an individual bond position. We can hold it till maturity, and we're going to capture that yield to maturity. You can't say that with a bond fund because the portfolio is always changing.
Good point.
The other thing with bonds is take a look at your credit quality. So far, credit quality has not been an issue. If we're going into recession, we would expect that credit spreads to widen out, and that just means that the yields offered by very high quality bonds and the yields offered by low quality bonds widens. And when that happens, the yields on the junky bonds goes way up, and as a result, the prices go way down. So you can get ahead of that curve by improving your credit quality now. The other thing about junky bonds is when their prices fall, the liquidity dries up. So it's harder to sell those positions, and so you're going to take an even bigger loss when you sell them. Well, that leaves one asset class, cash. All right, we talked about cash last week a little bit. Cash, nothing sexy about cash. It is what it is. But cash, you're not going to lose anything on a nominal basis. Yes, you're losing purchasing power, but in stocks and intermediate and long-term bonds, you're losing on a nominal basis too. So cash is dry powder. And there's nothing wrong with having dry powder because, like I said, you're not losing anything on a nominal basis, and it's ready for you to deploy as prices get more and more favorable.
If they get more and more
If they
favorable.
get more favorable, yes.
We generally don't like having a lot in cash because we think that we can find something that, if your time horizons are a few years, we're going to earn considerably more. And you are moving way backwards right now on a real basis after you net out inflation.
But you just said it, Jag, and that's the key. If your time horizon is sufficiently long. So this is not the post-credit crisis bull market where anyone can make money in stocks and you had the Fed supportive. No, if someone has a very short investment time horizon, they probably need to have it in very liquid, safe things like cash, because you could get yourself in a situation
correct.
where if you're putting money into AMC stock because it just went up or whatever. Don't mean to pick on AMC, but GameStop, whatever.
Robinhood.
Yeah, and we go on and on and on. Probably not a wise thing to do right now.
Yeah, I agree.
Those are just some general recommendations that we would make to weatherproof, and you can decide for yourself whether this is the time to weatherproof or not. We think it is. And if you agree that it's time to weatherproof, and if you would like some help in doing that, give us a call, and we'll gladly walk you through these and help you in weatherproofing for what we believe is coming.
Well, Bill, our viewers may want to get back to the Masters coverage.
Probably not.
At Augusta National in Georgia.
Well, they could turn on ESPN.
So, but that's the biggest sport event of the weekend, the Masters. It's the only major that's played on the same course every single year.
I think there's a collegiate pickleball tournament this weekend.
That's definitely rising in popularity. Have you played pickleball?
I will one day.
Okay.
I'm not ready for prime
It's a
time.
short supply of pickles.
Okay. But the big sports news story of the weekend is the triumphant return of Tiger Woods to any previous winner of the Masters is automatically invited, and they have all the way up until their tee time just about to state whether they're going to tee it up or not. And Tiger waited till about 2 days prior. And this is a man that had almost had his leg amputated in 2020. I think at the end of 2020, remember COVID? We had COVID shut down the PGA, and the last Masters tournament was played in November of 2020. So, and then I guess we played last year in April. But Tiger is, he was -1. He's tied for 22nd right now at +2 on the 10th hole. And so unless he does something really poorly, which can happen, he's going to make the cut.
That's remarkable.
A remarkable feat. And the Texan, Scotty Scheffler, who has climbed to world number 1, is leading at -4, -1 today through 9 holes. I think that's about it, William.
Yeah, I think that's it too. So there you have it. And we wish you all a great weekend. Cheers.